If your bank account disappeared tomorrow, most people watching this would be financially finished within 30 days because it's not bad luck that destroys wealth. It's 7 silent money mistakes almost everyone makes daily. And today, think about this. You work hard, you earn money, but somehow it never feels like enough. No matter how much comes in, it goes out just as fast. That's not random. That's a pattern, and patterns can be broken, but only if you see them clearly. If you've made even one of these mistakes, you're not alone, but you do need to fix it. Stay with this, because the next ones are the difference between staying stuck and actually building real wealth. Living beyond your means is one of the fastest ways to quietly destroy wealth because it creates a gap between what you earn and what you keep. Many people assume higher income automatically leads to financial security, but in reality, expenses tend to rise just as quickly, if not faster. This is known as lifestyle inflation, where every raise, bonus, or new income stream is immediately absorbed by upgrades, better cars, larger homes, more dining out, and unnecessary subscriptions. Instead of building assets, individuals build obligations that require constant income just to maintain. Over time, this creates financial pressure, leaving little to no room for saving or investing, which are the real drivers of long-term wealth. The danger becomes even more serious when unexpected events occur, such as job loss or economic downturns, because there is no financial cushion to absorb the shock. People living at or beyond their means are often forced into debt just to sustain their lifestyle, creating a cycle where future income is already committed to past spending. This not only limits financial freedom, but also increases stress and reduces flexibility in decision-making. Wealth is not determined by how much you earn, but by how much you retain and grow. And when spending consistently matches or exceeds income, the ability to build anything meaningful over time disappears, leaving individuals stuck in a pattern of earning and spending without ever progressing financially. Ignoring debt is one of the most damaging financial behaviors because it creates a silent drain on your future income while giving the illusion that everything is under control. Debt, especially high-interest debt like credit cards, doesn't just sit there, it compounds against you, growing faster than most people realize. Each month you carry a balance. Interest accumulates, turning small purchases into long-term financial burdens. What makes this dangerous is that minimum payments make the situation feel manageable, but they mainly cover interest rather than reducing the principal, keeping you stuck in a cycle that can last for years. Over time, a significant portion of your income is redirected toward servicing debt instead of building wealth, which limits your ability to invest, save, or take advantage of opportunities. It also reduces financial flexibility, meaning unexpected expenses often lead to even more borrowing, deepening the problem. Psychologically, ignored debt creates stress and avoidance, causing people to delay action until the situation becomes overwhelming. This delay increases total repayment costs and extends the time it takes to recover financially. In many cases, individuals underestimate how much interest they are actually paying, failing to see how aggressively it eats into their earning potential. Debt, when unmanaged, essentially works against you every single day, making it harder to move forward no matter how much you earn, and slowly locking you into a position where progress feels impossible despite continued effort. Not having an emergency fund leaves you financially exposed in ways most people underestimate until it is too late. Life is unpredictable. Job loss, medical bills, car repairs, or sudden expenses can appear without warning, and without a financial buffer, even a small disruption can turn into a major crisis. When there are no savings to fall back on, people are forced to rely on high-interest debt or liquidate long-term investments at the worst possible time, both of which damage future wealth. This creates a chain reaction where one unexpected event leads to multiple financial setbacks, pushing individuals further away from stability. The absence of an emergency fund also limits decision-making power as people feel trapped in situations they would otherwise leave, such as a toxic job or a bad financial commitment, simply because they cannot afford a temporary loss of income. It adds constant pressure, knowing that any disruption could collapse your entire financial structure. Over time, this stress influences behavior, often leading to more conservative or reactive choices rather than strategic ones that build wealth. An emergency fund acts as a shock absorber, allowing you to handle disruptions without derailing your long-term goals. Without it, every financial plan becomes fragile, dependent on everything going perfectly, which rarely happens, leaving you vulnerable to setbacks that could have been easily managed with even a modest level of preparation. Chasing trends is one of the most common ways people lose money because it is driven by emotion rather than understanding. When an investment becomes popular, whether it is a hot stock, cryptocurrency, or real estate surge, most people hear about it after prices have already risen significantly. At that point, excitement and fear of missing out take over, pushing them to buy without fully understanding what they are investing in. Instead of analyzing fundamentals, risks, or long-term value, decisions are based on hype, social media noise, or short-term success stories. This often leads to buying at inflated prices where the upside is limited and the downside risk is high. As soon as the trend slows or reverses, panic sets in, and many end up selling at a loss, locking in the very outcome they were trying to avoid. This cycle of buying high and selling low repeats because the focus is on reacting rather than planning. Trend chasing also prevents the development of a consistent investment strategy, making financial growth unpredictable and unstable. It creates the illusion of quick wealth, but in reality, it erodes capital over time. Sustainable wealth is built through disciplined, informed decisions, not by jumping from one opportunity to the next based on popularity. Without a clear framework or understanding, following trends turns investing into speculation, where outcomes depend more on timing and luck than on skill or long-term thinking. Overconfidence is a subtle but dangerous financial mistake because it distorts judgment and encourages risk-taking without fully considering potential downsides. It often develops after a series of successful decisions where individuals begin to believe their results are due to skill rather than favorable market conditions or luck. This false sense of control leads to larger, more concentrated bets, reduced diversification, and a tendency to ignore warning signs that would otherwise signal caution. People start to trust their instincts over data, dismiss opposing viewpoints, and underestimate how quickly conditions can change. As confidence grows, so does exposure to risk, often without any protective measures in place. When markets shift or unexpected events occur, these positions can unravel quickly, leading to significant losses. What makes overconfidence especially damaging is that it prevents learning, as individuals may attribute failures to external factors instead of recognizing flaws in their approach. It also reduces discipline, leading to inconsistent strategies and impulsive decisions that deviate from long-term goals. In many cases, overconfidence causes individuals to abandon proven principles such as risk management, diversification, and patience, replacing them with short-term thinking and emotional reactions. This creates a fragile financial position where success depends on continued favorable conditions rather than a solid foundation, increasing the likelihood of sharp setbacks that can erase progress and make recovery more difficult over time. Waiting too long to invest is one of the most costly financial mistakes because it sacrifices the single most powerful advantage in wealth building: time. The longer money is invested, the more it benefits from compounding, where returns begin generating their own returns, creating exponential growth rather than linear progress. Delaying this process, even by a few years, significantly reduces the final outcome, not because of how much you invest, but because of how long that money has to grow. Many people postpone investing because they feel they need more income, better timing, or perfect market conditions, but in reality, those delays often result in missed opportunities. Markets move in cycles, and waiting for certainty usually means entering after the biggest gains have already occurred. Fear of loss also plays a role, causing individuals to stay on the sidelines while inflation steadily reduces the purchasing power of their savings. This creates a hidden loss where money appears safe but is actually losing value over time. Additionally, the longer someone waits, the more pressure they place on future contributions to make up for lost time, often requiring higher risk or larger investments to reach the same goals. Early investing allows for smaller, more manageable contributions to grow into significant amounts, while delays force a more aggressive approach later, increasing both stress and risk and making it much harder to achieve long-term financial stability. Relying on a single income stream creates a fragile financial structure because it concentrates all your stability into one source that can be disrupted at any time. For most people, this means depending entirely on a job, which is ultimately controlled by external factors such as company performance, management decisions, or broader economic conditions. No matter how secure a position may seem, it is never completely guaranteed, and a sudden loss of income can immediately impact every aspect of financial life. When there is only one source of income, there is no buffer or backup to absorb that shock, forcing individuals to rely on savings or debt to cover basic expenses. This not only accelerates financial strain, but can also undo years of progress in a short period of time. In addition, a single income stream limits growth potential, as earnings are typically capped by salary structures, promotions, or working hours. This makes it difficult to significantly increase wealth without adding new sources of income. Multiple income streams, whether through investments, side businesses, or passive income, provide diversification similar to a well-balanced portfolio, reducing overall risk and increasing financial resilience. Without that diversification, any disruption becomes more severe, leaving individuals vulnerable to circumstances beyond their control and making long-term financial security much harder to achieve. Ignoring the broader economic picture is a mistake that can quietly erode wealth because it leaves individuals unprepared for changes that directly affect their financial situation. Inflation, interest rates, market cycles, and government policies all influence the value of money, the cost of borrowing, and the performance of investments. People who focus solely on their immediate income and spending often fail to see how these larger forces are shifting the ground beneath them. For example, high inflation reduces purchasing power, meaning that even if income remains the same, the ability to buy goods and services declines. Rising interest rates increase the cost of loans and mortgages, making debt more expensive and reducing disposable income. Market downturns can erode investment portfolios if positions are not diversified or risk managed, while fiscal and regulatory changes can affect taxes, investment returns, and business opportunities. Ignoring these factors often results in reactive decisions, selling assets at a loss, taking on debt at the worst time, or missing opportunities to capitalize on favorable conditions. Wealthy individuals and successful investors pay close attention to economic trends, adjusting their strategies to preserve value and take advantage of shifts. Being aware of the bigger picture allows for proactive planning, risk mitigation, and smarter allocation of resources. Without this perspective, even disciplined saving, investing, and budgeting may fail to protect wealth from forces beyond personal control, leaving individuals vulnerable to setbacks they could have anticipated and managed effectively. Building and preserving wealth is not about luck, timing, or working harder. It's about avoiding the silent mistakes that quietly erode financial security. Living beyond your means, ignoring debt, lacking an emergency fund, chasing trends, overconfidence, delaying investment, relying on a single income, and overlooking the broader economic picture all chip away at progress over time. Each mistake alone can slow growth, but together they create a compounding effect that leaves individuals vulnerable, stressed, and far from their financial goals. True financial strength comes from discipline, awareness, and proactive decision-making, controlling spending, managing debt, preparing for emergencies, investing consistently, diversifying income, and understanding economic realities. Wealth is built steadily, not suddenly, and it requires conscious choices every day. By recognizing these common pitfalls and addressing them, anyone can shift from reacting to circumstances to controlling their financial future. Avoiding these mistakes doesn't guarantee instant riches, but it lays the foundation for lasting stability, growth, and freedom, allowing your money to work for you rather than against you. The difference between financial struggle and security is not in luck, but in decisions, and the sooner these lessons are applied, the greater the advantage in building real, lasting wealth.